Let's go to the next transaction. We purchased a computer, a printer, and some software for the business. The total price was $4,500. We paid cash. The estimated useful life is 3 years. It's not going to be worth anything at the end of 3 years, no salvage value. The straight line depreciation, that just means we're going to take however much we spent and divide it by the number of years it's going to last. That's it. That's all that means. So, how much did we spend? $4,500. It's going to last how long? 3 years. Well, it seems to me that if we bought something that cost us $4,500, and it's going to last 3 years, that my depreciation is going to be $1,500 a year. Is that what you're thinking? All right, good. So we're going to record this transaction in 2 parts. Which transaction number is this, by the way? 3. So let's turn to our Rosetta Stone. Let's turn to the Rosetta Stone. Do you see line number 3 right there? You see that? That's the line we're going to start with. So I got to record the purchase of this equipment. I want you to record this transaction. You don't need me. You guys are little accountants. Y'all are just unbelievable. Record this transaction. Did you use some cash? How much? Good. Write it down. Did this transaction have anything to do with notes payable? Does the wording have anything to do with common stock? No. When you read the language, does it have anything to do with inventory? How about accounts receivable? Accounts receivable? No. How about taxes payable? No. It doesn't. What do we use the $4,500 for? Property, plant, and equipment. Do you see a column called property, plant, and equipment? I do too. So it looks to me like on line 3, under cash, we used how much? $4,500. And under property, plant, and equipment, I think, did our property, plant, and equipment go up or down? It went up by $4,500. Is that right? So I took away $4,500 on the left-hand side, and I added $4,500 on the left-hand side. Is that right? Am I still in balance? I think what I did is I traded one asset for another asset. Isn't that what you're thinking? I traded some cash for a computer, a printer, and some software. Now I got to record the depreciation. Look at the left-hand side. Do you see right there depreciation right underneath interest? DEP, that's depreciation. Now let me ask you a question. When I depreciate this asset that I bought for $1,500, I think what I'm doing on my balance sheet is I'm reducing the value of that asset on the balance sheet. So I'm pretty sure I'm going to be in this column right here that's called property, plant, and equipment. And I'm going to be on this line right here that's called depreciation. So in this box right here, where property, plant, and equipment and depreciation intersect, I think in that box I need to write down one of my numbers. What do you think? Good. What number do you think I ought to write down? Minus $1,500. I would agree with that because I'm reducing this column, property, plant, and equipment, the total. I mean, if I totaled that column for the end of the year, I started with $4,500 and then I expensed $1,500. I used up $1,500 worth of value according to the taxing authorities and the accountants. Am I in balance? No. Let me ask you a question. Is depreciation an expense? Do expenses reduce earnings? Do you see an earnings column up there someplace? I do too. Why don't you write in the number? You write in the number. I'm pretty sure I'm going to be on this line that says depreciation. I think I'm going to be in that last column that says RE, earnings. I think in that box where those two intersect, do expenses reduce earnings? Is that right? So this is going to be a negative number. Is that right? Good job. Have I just converted these words to the scorecard? Did I just do that? Good. Let's go to the next transaction. Next transaction is we purchase enough inventory to actually make 75,000 quarts. The inventory raw materials cost 20 cents per quart. We paid cash. Holy cow, I got to do some math. I got 75,000 quarts, and I paid 20 cents a quart. So if I multiply 20 cents times 75,000, boy, I get all done with the math, and I've got $15,000 of inventory that I've bought. Is that right? Yeah, that's what I think. I think I bought $15,000 worth of inventory. Did I pay cash for that inventory? Yes. Now let me ask you a question. Do I have $15,000 of cash? Turn to the Rosetta Stone. Do I have 15? Look at all my cash. I got 13,000 positive, and then I've used 85. I've used 9,300 of cash out of. Do I have 15,000 of cash to buy all this inventory? No. Now let me tell you something that's critical. Do you remember what I said, that a balance sheet is a snapshot? When is the snapshot for this balance sheet being made? At the end of the year. So over the course of the entire year, we spent $15,000 on inventory. Not all right now, because the inventory is part of a movie. What I'm looking at right now is a snapshot as of the end of the year. So, by the way, which transaction number is this? Transaction 4.1. Let's record that. Do you see 4.1 on the left? Good. Did we use some cash? How much? 15,000. Write it down. What did we spend that cash on? Inventory. Do you see that column? Good. Write it down. In that column, write it down. This is not pin the tail on the donkey, right? You don't have to guess. Oh, God, I don't know what I spent the money on. Yeah, you do. You spent it on inventory. Find that column, record it. So, am I in balance? Yes, I am. So now I bought some inventory. Did I have that much cash? Not according to this balance sheet, but I'm not done yet. The year isn't over. There's some other stuff that's going to happen. Let's go to transaction 4.2. We're going to sell 50,000 quarts at $1 each. Of the 50,000 in sales, 31,000 was in cash, and 19,000 was in receivables. Holy cow, this is complex. I had sales, I had revenue of 50,000, of which receivables were how much? 19,000, is that right? And cash was 31,000. So let's go to our Rosetta Stone. I'm on line 4.2. Let's start with the cash. As a result of this transaction, did my cash go up or down? How much? Good. Write it down. Write it down. My cash went up by 31. Did my receivables go up or down as a result of this transaction? Up by how much? 19,000. Write it down. Now, let me ask you a question. You know how a minute ago I said expenses are bad for earnings? Would sales be good for earnings? Yeah, they would be. Sales would be good for earnings. Do you see a column that says earnings? Very far right, under retained earnings. Is that right? How much were our sales? 50,000. Is that good for earnings? Good. Let's write that number in the box. Is that line now in balance? So I got 31,000 in cash, 19,000 in accounts receivable. Those two added together are 50,000. 50,000 on the left-hand side equals 50,000 on the right-hand side. Is that right? So I'm in balance. Now let me ask you a question. Did I use some inventory? All right, now I got to fool with that right now. So we're going to look at line 4.3. Line 4.3. Now, I think what I did is I bought 75,000 quarts for 15,000 of cash. I think I used 50,000 quarts. Is that right? So I used 2/3 of my inventory. Is that what you're thinking? How much did I pay for each quart? 20 cents. So if I take 50,000 that I used and I multiply that times 20 cents, how much inventory do you think I used? I think I used 10,000 of inventory. That's what I think happened. So I'm going to go then to line 4.3 on this piece of paper, line 4.3, and I'm going to say, all right, I know that my inventory got impacted as a result of this, so I'm looking at line 4.3. I'm looking at the column that's called inventory. How much did my inventory, as a result of these sales, did my inventory go up or down? Down. How much? Let's write it down. Let's write it down. Now, the inventory that I sold, did that reduce my earnings? Was that a cost of goods sold? I think it was. I think that $10,000 of inventory that I sold is an expense, and expenses reduce earnings. Do you see a column called earnings? I do too. Let's write it down. Go to that column called earnings, and on the line that says 4.3, and over to the right it says COGS. Do you see that on the far right? Cost of goods sold. So let's write down negative 10. My earnings went down by 10. Is that right? Good. Whew. Transaction number 5. Y'all are doing great. Here we go. Expenses for rent, office supplies, sales, payroll, advertising totaled $18,500 for the year. We paid cash for $16,500. So how much cash did we use? $16,500. Let's turn the page on the Rosetta Stone. What transaction number is this, by the way? 5. Do you see a 5 on the far left-hand side? I do too. So we're going to be dealing on that line. How much cash did I use? $16,500. So my cash just went down by $16,500. Is that right? All right, good. If my expenses were $18,500 and I only paid for $16,500, do you think I owe somebody some money? Yeah. How much do I owe, by the way? $2,000. Now, this money that I owe, is it for taxes? No. Is this money that I owe for a note that I signed with the bank? No. What is this money for? Accounts payable. So I'm going to look up here under O, liabilities. I got accounts payable, taxes payable, notes payable. So good. I'm going to be in accounts payable in that column on this line right here, in that box where line 5 and accounts payable intersect. In that box, I'm going to write down a number. Now, 2,000. And since my accounts payable went up, it's going to be a negative number or a positive number? A positive number. You're exactly right. My accounts payable went up by 2,000. Now, am I in balance? No. Well, what's my problem? My problem is how much were my total expenses? $18,500. Do expenses reduce earnings? Do you see a column that's called earnings? I do too. That far right-hand column. In that far right-hand column, retained earnings. In that column on line 5, where those two intersect, right next to it, it says operating expenses. I need to write a number in that box. What number do you think I need? Is it a positive or a negative? It's a negative because expenses reduce earnings. Is that right? Am I in balance? Good. Last transaction. Estimated income tax came to $2,000. Of that $2,000, we paid $1,500 of it. Did we use some cash? Good. By the way, what transaction is this? 6. So let's go down here. You got a line right here that says taxes, real near the bottom. How much cash did we use? $1,500. So let's write that down. Write down negative $1,500. By the way, did we owe anybody any money as a result of this? Yeah. How much? $500. We owe it for taxes. Is that right? I see a column up here called taxes payable. So in that column where tax and taxes payable intersect, in that column, in that box right there, I'm going to write down a number. How much? $500. But since I owe it, it's going to be negative, right? But I owe it. Oh, yeah, you're telling me my taxes payable went up, therefore it's a positive number. Is that right? I guess. So I'm going to write down positive. Am I in balance? No. Are taxes an expense? Do expenses reduce earnings? Good. Do you see a column called earnings? Good. Write that number. How big were our taxes? 2,000. I'm going to write down a negative 2,000 or a positive 2,000? Negative. So let's write it down. Am I in balance? Yes, I am. Now watch. Here's the key. You can write down these numbers. I'm not going to make you do the math. If we total this entire column right here that says cash, start with 5,000, then 8,000, then we use 4,500, then we use, if we total that column, and we were going to put a number under the BAL, balance at 1231, down there at the very bottom, what do you think the total of that column would be without guessing? Where did you get that number? From the balance sheet. So go back to that first piece of paper in this section, and on the balance sheet, you're going to see 1,700. Is that right? Look at the column called accounts receivable. This will be real easy. Add up, and put in the box that says balance 1231 under accounts receivable. What number do you think that is? 19,000. Yeah, and if you look at inventory, what number do you think that is? 5,000. Property, plant, and equipment is 3,000. Is that right? Do you recognize these numbers from the balance sheet? Yeah, you do. Take a look at accounts payable. That's 2,000. Taxes payable is 500. Notes payable is 4,000. Common stock is 5,000. And I think if you add up retained earnings, if you add up that whole column right there, you're going to come up with a total of plus 17,200. Is that what you're thinking? That's what I'm thinking. Where have I seen that number before? On not only the balance sheet, 17,200, but I've also seen it on an income statement. Is that right? Watch this. I'm going to total for you the entire balance sheet. So assets are a total of 28,700. Liabilities are a total of 6,500, and owner's equity is 22,200. If you add that whole thing up, it's going to say 28,700 equals 28,700. Are you in agreement with that? So you know what you just did? This is the coolest part. What you just did is you took a whole bunch of words and you just line by line converted those words to numbers. And as a result of that, what you created is a balance sheet right here across the bottom. That's a balance sheet right there. Retained earnings, 17,200. Common stock, 5,000. Accounts payable, 2,000. Accounts receivable, 19,000. Total assets, 28,700. You took a bunch of words and converted it into numbers, transactions. Now, I want you to take a look at the far right-hand side. See all that stuff right there under earnings? You know what I think that is? I think this whole, and you can see it's kind of red right here. I think that what that really is an income statement. I mean, take a look at that. I think if you look right next to that far right-hand side under earnings, it says revenue or sales. How much was our revenue? 50,000. Right underneath that, you see cost of goods sold? How much was that? 10,000. Right underneath that, you see something called operating expenses? How much was that? Have you seen these numbers before? Where have you seen them? On the income statement that your accountant gives you. But here's the cool part. The cool part is that on one piece of paper right now, I got a balance sheet across the bottom and I got an income statement across the right-hand side. How cool is that? Oh, this is like very cool. Because it's not on two pieces of paper. I think... Well, by the way, how many scorecards are there? The first one that we talked about is A. The second we talked about is A. The third one we talked about is A. Do you see a column up here called cash? I do too. It's over here on the left-hand, I think it's over here on the left-hand side. See that left-hand side right there? That's all the cash. If you take a look at the third page of this handout, which is called a cash statement, I think you'll find every single one of these numbers in a different order, but you're going to find all these numbers on that piece of paper. So here's what I got. Right now, I got a balance sheet across the bottom, I got an income statement on the right, and I got a cash statement on the left. Is that right? How many pieces of paper have I got? One. I got one piece of paper that has a balance sheet, an income statement, and a cash statement, all on that one piece of paper. Now, here's what's cool. This is the Rosetta Stone. You're about to do it. I want you to look at transaction number 1. Without remembering the words, forget about the words, forget about the activity. Look at the numbers. Only look at the numbers. Look at the scorecard. Look at the Rosetta Stone. I want you to tell me what happened in transaction number 1. What happened? What looks to me like our cash went up by $5,000. How did that happen? Well, I look across and I go, oh, I must have sold some stock. Is that right? Don't remember the words. Don't remember what you read a minute ago. Only look at this piece of paper. Look at transaction number 2. What happened? You borrowed some money. How much did you borrow? How do you know you borrowed money? Because your cash went up and your notes payable went up. I mean, holy cow, how hard is this? My cash went up by $8,000. Where'd that cash come from? Oh, yeah, I must have borrowed some money. It's under notes payable. Look at the third transaction. What's the third transaction say? Well, my cash went down by $4,500. Well, what did I use that cash for? Property, plant, and equipment. So if I was going to convert these numbers back into words, I'd say, well, I must have used $4,500 of cash to buy some assets. Would that be true? Yeah. Look at the fourth transaction. What did I do? I used some cash. How much? What did I use it for? I bought some inventory, apparently, because my cash went down by 15 and my inventory went up. Do you see what I'm doing? Do you see what you're doing? After an hour, you're converting numbers back into words. That is unheard of. I know accountants that can't do this. I know Harvard MBAs that cannot do this. This is unbelievable to have the ability to go both ways. You can take activities and get them onto the scorecard. You can read the scorecard and say, okay, what happened? What happened right here on 4.3? Somebody tell me what happened. My inventory went down. Well, what happened to it? I must have sold it because it's a cost of goods sold. Is that right? I mean, how hard is this? Look at this pick one. Look at number 5. You say, all right, my cash went down by $16,500. Well, why? What happened? Oh, man, and on the same line, I borrowed some money. How much did I borrow? $2,000. So what all that cash and that borrowed money, what was that for? Operating expenses. It reduced my earnings. Right here on one piece of paper. This is the slickest tool you'll ever see in your life. And I'm going to tell you, the brain cells I had to burn to create it are breathtaking, all right? Because I know how this stuff works, and I know that all 3 of them fit together, and I've been trained to look at 3 pieces of paper and hear the story. The problem is, unless you got a degree in accounting and 35 years worth of experience, it's going to be almost impossible to do. Let me ask you a question. Could you take this form right here and give it to your accountant or your bookkeeper? Could you do that? Could you say to your accountant and your bookkeeper, you know what? I love the 3 pieces of paper. They're the coolest. I want you to keep doing that for me because I know how much you love them. I want to keep getting them. And I'd kind of like to get my scorecard, not my financial statements. I'd like to get my scorecard so that I can keep score. And give them this form, the Rosetta Stone, and every month you just have them just plug in the numbers. Okay, how much cash, how much accounts receivable, how much inventory, what happened to our earnings. Just have them plug the numbers in this. Let them keep doing the way they've been doing it because that's very important to them. But it doesn't help you a bit. Because you got 3 pieces of paper. How in the world can you take 3 pieces of paper and convert the whole thing back to, what's the story? Do you guys know the story on this business right now? Kinda. There's still one more thing that you're missing. And that last thing, see that empty column right in between the number on the left-hand side and the cash column, there's an empty column. And in that empty column, I've recorded O's and I's and F's. So anytime I used O cash, what is O cash? What is O? Operating cash. I put an O. Anytime I use financing cash. So let me ask you a question. When a business raises money from the shareholders, is that O, I, or F? That's F cash. That's financing cash. When a business borrows money from a bank, is that O, I, or F cash? That's F cash. When a business uses some cash to buy property, plant, and equipment, is that O, I, or F? That's I. So I've gone through, and each place there's cash. I've written down to help you O, I, F. So number 1 is F, number 2 is F, number 3 is I. 4.1 is O. That was for buying some inventory. 4.2 is O cash. That's sales. 4.3 doesn't have anything to do with cash. That was selling inventory. That didn't have anything to do with cash, right? Because if it would have had something to do with cash, it'd be right there in that box. I don't have anything there. Look at number 5. Those are expenses, operating expenses. That's O cash. Look at depreciation. Doesn't have anything to do with cash. Taxes, that's O cash. And repaying the note, that's F cash, financing. So now here's what's important. Did you know that really the only reason to have an asset, if you've learned this from me, do not call out the answer right now. What's the only reason to have an asset? Produce income. Why else? Why would you have an asset? Why do businesses have assets to begin with? What are they good for? Huh? To create value. I mean, I don't know about that, Steve. I mean, I'm kind of thinking the whole reason that a business has assets is to produce sales. That'd be the whole reason I'd want an asset. I want my sales to go up. And the whole reason to have sales is because I want to have profits. And the whole reason to have profits is because I want cash. So a business owner's job, when you stop and think about it, a business owner's job is to buy assets, convert those assets into sales, convert those sales into profits, and convert those profits into cash. Would that be true? Yeah, that's it. That's a business owner's job. This is what we're supposed to be doing. Now, my question is, what kind of cash are we talking about? Profits into cash. What kind of cash? Just any kind of cash or what? Take-home cash. Well, maybe take-home cash, but really, looking at this right here, profits are going into cash. What I really want, I think I want operating cash. Operating. How good is my business at converting profits into operating cash? Because the money that I borrow is financing cash, and the money that I get from maybe selling my computer or my vehicle or my real estate, that's investing cash. The health of my business, I'm going to say this very carefully. Listen, the health of my business is not dictated by how much the profits are. The health of my business is dictated by how good I'm doing at converting my profits into cash. What kind of cash? Operating cash. So let's do a little math. I've got all the O's and the I's and the F's. I think if you add up all the O's, they'll add up to negative 2,800. If you add up all the I's, it'll add up to negative 4,500. And if you add up all the F's, it'll add up to a positive 9,000. Now, let me ask you a question. If we started with zero cash, and this is the cash flow during the course of the year, how much do you think our ending cash would be? 1,700. Is that right? That's our ending cash. Where have we seen that number before? On the balance sheet. Go back and check page 1 of your handout. Look at the very top. It says cash. How much cash? $1,700. How did we get there? Well, I'll tell you how we got there. How much did we have in profits? Oh, yeah, $17,200. Our profits in this business, the profits were $17,200. And as astute little business owners, we successfully converted $17,200 of profits into a real live cash loss of $2,800. That's what we did. That's what we did. That's what this piece of paper says. This piece of paper says, hey, Keith, not so fast on going to drink those little blue drinks with umbrellas in Tahiti, buddy. You may be a little premature. There might be just a tad more work to do before you start leaving your business for months at a time. And the tad more work is that as a business, the only reason this business is still alive is because of financing cash. The business lost cash from operations. It lost or used cash in investing, and it borrowed and raised money to stay alive. Can that happen in the real world? Yes. Let me ask you a question. I'm going to ask you a question. Do you remember the income statement? Turn in your piece of paper to the income statement. That'd be sheet number 2. Turn to sheet number 2. It's the income statement. In this handout, do you see that income statement? Look at the bottom line. What's it say? Net income, $17,200. What did I tell you guys? I said, I know, don't hear me now, believe me later. That's what I said. I said that this piece of paper right here, that's $17,200. This piece of paper right here is 100% theory. There's not a factual piece of information on this piece of paper. It's a theory. It's a good theory. It's an important theory. It's a critical theory. But there's nothing factual on it. What I said to you was the piece of paper that's got the real information on it is this piece of paper right here, OIF. This piece of paper is not a theory. This piece of paper called a cash flow is a fact. Is that right? Factually, here's what happened. Factually, as astute little business owners, we converted $17,000 of profit into a real live cash loss of $2,800. That's what happened. Now let me ask you a question. Do you think all cash is created the same? No, I don't either. I don't think all cash is created the same. In fact, I think there's a grand poobah of cash. I think there's like the gorilla of cash. And the gorilla of cash is cash. Operating cash is everything in a business. So our business didn't do that good a job. I know what you're thinking. You're sitting there thinking, well, Keith, this is a great theory. How does this apply in the real world? Let's look at the real world. We're going to look at the real world. Here we go. This is a real live business. In 1999, this real live business had income or earnings of $827 million. So this is a good-sized business. The next year, they had earnings in 2000 of $896 million. And the first quarter of 01, first 3 months, holy macanoli, their earnings are $405 million. These guys are on fire. They are on fire. Look at the first 6 months. Their earnings are $788 million. Man, they're already 80% in half a year to where they were for all of the prior year. Is this company hot? This is hot. This baby is moving. Let's take a look at their earnings per share. So it goes from $1.10 to $1.12. First 3 months of 01, they got 49 cents. Dang, for the first 6 months, they're at 94 cents a share. These guys are smoking them. Let's take a look at how they're doing on cash. They got $288 million of cash in 1999. Then they got $1.3 billion in 2000. Then they got $1.1 billion in first quarter. And Then they got 850 million, 847 million in the first 6 months. But even so, the first 6 months of this year, of 2001, they're still about 3 times bigger than where they were just 2.5 years ago. These guys are doing great, right? Now, my question is, who are the smartest? By the way, you could buy this stock if you wanted to in March. You could buy this stock. You could buy this stock if you wanted to at $61 a share. All right? So, on Wall Street, who are the smartest people on the planet? They're brokers, right? So they're brokers. They're real estate. These are the smartest people on the planet, right? Goldman Sachs. You ever heard of those guys? Lehman Brothers. Ever heard of those guys? Bear Stearns, right? The smartest. These are like the smartest people on Wall Street. Let's see what the smartest people on Wall Street said about this real live business. Let's just see what they said. And they said, you know what? On March the 12th, 2001, they said at $61 a share, Lehman Brothers said this is a strong buy. Better believe them, right? How are they doing? Smartest guys on the planet, right? Here we go. On March 21st, Merrill Lynch said it's a near-term buy. It's $55 a share. On March 29th, Goldman Sachs said, we recommend this thing at $55 a share. On June 8th, Bear Stearns, smartest people on the planet, said this baby's attractive at $51 a share. By the way, what could I have bought it for March the 12th? $61. So I'm down to 51, but that's okay. Markets ebb and flow. This could still turn out to be, maybe it's just gone on sale. For all I know, Wall Street's having a sale. Maybe I need to pick it up. All right, but they're telling me to. Strong buy, near-term buy, recommended, attractive. J.P. Morgan, smartest guys on the planet. Better buy it at $47 a share. Better accumulate it, said A.G. Edwards on June 22nd. Strong buy, said Bank of America at $40 a share. We recommend it, said Goldman Sachs. This baby's attractive, said Bear Stearns. I think you ought to own it at $30 a share, Saunders Norris. We recommend it, said Goldman Sachs at 33. Better buy it, said A.G. Edwards. Strong buy, said First Albany. Long-term buy, said Merrill Lynch at $33 a share. Better buy it, said CIBC at $20 a share. This baby's on sale. Let's own it. Long-term buy, said J.P. Morgan. Strong buy. The stock is attractively priced, said the smartest people on the planet at Lehman Brothers. This helps explain what happened to Lehman Brothers in case anybody's wondering, right? We better buy it, said First Albany. Market perform, said Bank of America. You know what market perform means? That means we don't know. We don't have a clue, right? If you own it, keep with it. If you don't own it, stay away from it. Better buy it, said Smith Barney. Oh, finally, neutral. Now take a look. From August 9th, these idiots said long-term buy, Merrill Lynch, long-term buy. It goes down to 11. How many days is that? From October 9th to November 1st. How many days is that? 22 days. Is that right? So in 22 days, the smartest guys on the planet went from long-term buy to, I don't know, neutral. I don't know what's going to happen. But look at the stock price. It went from 33 to 11 in 22 days. Holy cow, this baby's on fire, right? Not going to tell you to bail out. We're just neutral on it. However, CIBC, smartest guys on the planet, said you better own it. Hold on, said Prudential. It's always darkest before the dawn. Is that right? I mean, this baby's coming back. I know it feels bad. I know it started at 61 and you're at $9.24, but don't worry. Hold on. It's coming back. Maintain your position, said Edward Jones. Market perform, said Goldman Sachs. Hold on, said CIBC. Hold on, said UBS Warburg. Smartest guys. This stock is at 61 cents a frickin' share, and they're saying hold on. For crying out loud, you guys, what are we thinking about? Hey, it gets worse. Hold on, said Credit Suisse. Now, wait a minute. This is 2001. This is the same year. This is not a different year. This is the same year. This baby's gone from 61 down to 36 cents in that length of time. And these guys are telling you to hold on, market perform, better buy it, better buy it. December the 2nd, 2001, this stock went to zero. The name of this company is Enron. Enron files bankruptcy, right? So that's all anybody knows, except you and I now know the rest of the story. Do you realize that every quarter, every business, every single business that's a public company has to send out to everybody these three pieces of paper? Every shareholder, every single employee, all of Wall Street got these three pieces of paper. And what Wall Street saw is that this number right here is really, really juicy. And they saw that this number right here is actually holding up pretty well. The problem is nobody got bothered to look at how this cash right here was actually created. Because this number right here, the earnings of the business, I keep forgetting, is that a theory or a fact? It's a theory. So this number right here, which came from down here on an income statement, this number right here is a theory. And this number right here is a fact. Now let's see how they got to the amount of cash that they said they had, because that's factual information. So we'll look at the next slide. The next slide says, you've seen this before, here are the profits. You already saw this one, the profits of $827 in 1999 and $896 in 2000. Let's kind of take a look at where is their cash coming from. Well, their cash flow from operations in 99 was plus $1.2 billion. In 2000, it was plus $1.779 billion. Now, you know what they did? Take a look at 1999. What they did is they converted $827 million of profits into $1.228 billion of cash. Remember what I told you? One of management's jobs is to do what? Yeah, absolutely. One of management's jobs is to convert assets into sales, sales into profits, profits into operating cash. So this is how they did. I mean, they did pretty good in 99. They did really good in 2000. Take a look at the first quarter of 2001. How'd they do at converting profits into operating cash? Horrible. These guys successfully converted $405 million of profits into a real-life cash loss of $464 million. That's what they did. How'd they do in the first 6 months? These guys converted $788 million of real-life profits, in theory, into a real-life cash loss of $1,337 million. A billion. 337. They did that in 6 months. How much were their profits? $788 million. What's their operating cash? How big a swing is that? That's over $2 billion in 6 months. Do you know what Enron told everybody? Enron published their financial statements. They published these three pieces of paper. Everybody could see it. Here's what they said. Run. Run. Don't buy our stock. We're cooking the books. We're not converting our operating cash into earnings. Run. And you know what the guys on Wall Street said? Buy it. Buy it. You stupid people. We know you don't get it. That's what they said. And so here's all these people out here who don't know what you now know after an hour and a half. That's how long it's been. After an hour and a half, you now know that these guys said run. $788 million of profits, $1.3 billion of operating cash. How'd they do on investing cash? Well, they used some investing cash right here, and then they generated some, and Then they generated some more. And then in that last, first 6 months, looks like they used about $1.6 billion. Why is this business still alive? Take a look at financing cash. Take a look. This is the same problem our lemonade company had, isn't it? You take a look at financing cash. Why is this business still alive? Financing cash. Look right here at financing cash. Holy mackerel. In 99, they raised $2.4 billion. In 2000, they raised $570 million. In the first quarter, they raised from financing $1.3 billion. In the first 6 months of 01, they raised $1.9 billion, which nothing wrong with that if they would have been successful at converting their profits into cash. You take a look right here across the bottom, and what you'll see under financing cash, the only reason this business is still in business is because they borrowed and raised money. But as managers, as business owners, these guys suck at converting profits into what kind of cash? Thank you very much. Operating cash. I love this article. This article appeared in an Oregon newspaper on December 18th, which is after Enron filed bankruptcy. It says this: and as 2001 started, Tim Ramsey felt like $1 million. A 55-year-old electrical worker, Ramsey was ready to take early retirement after 33 years with Portland General Electric. His retirement nest egg, fed by more than 30 years of steady savings, had grown into a golden goose worth more than $1.25 million. As 2001 ended, the golden goose was almost a goose egg, having collapsed to less than $10,000. And Mr. Ramsey's retirement plans are nothing more than wishful thinking. I was a big sucker, Mr. Ramsey recently mused. For some reason, I don't know why, I listened to those people. I should have my butt kicked. And he did. He did. Let me ask you a question. How many scorecards are there? 3. The first one has things and stuff, what you owe, plus what you own. Is that right? All right, good. Assets equals, good. A balance sheet, is it a snapshot or is it a movie? It's a snapshot. The second scorecard that we talked about, what's it called? An income statement. It's kind of got 2 parts. Is that right? The real big top part, and there's 2 things in that. There is sales or revenue and minus expenses. And if you take revenue minus expenses, you're going to get the bottom part. Yeah, that's called profits. That's called the bottom line. Is the income statement a theory or a fact? It's a theory. It's the theory of whether or not your revenue exceeded your expenses. If it did, in theory, you have a profit. Can you spend your profits? Can you pay your bills with profits? That's why it's a theory. There's a third scorecard that we talked about. It's called a cash statement. A cash statement says that there's 3 places cash can come from or go to. The first one is operating cash. The second one is investing cash. The third one is financing cash. The balance sheet, which is assets, liabilities, and equity, the balance sheet is like a world atlas. It tells you, hey, you got this much cash, you got this much in profits. But if you want to look at the street map and find out how you got there, do you look at a balance sheet to see a street map? No. What do you look at? An income statement and a cash statement. An income statement is a movie or is it a snapshot? It's a movie. A cash flow statement, is it a movie or a snapshot? It's a movie. Do you think cash is important? Yes. What kind of cash? The whole reason to have assets is to produce sales. The whole reason to have sales is to produce. The whole reason to have profits is to produce cash, operating cash. Is that right? Look how much you've learned in an hour and a half. Give yourselves a hand. Very, very, very nice. Very, very, very nice. Was it hard? Was it fun? Do you think you could actually learn how to do this? Do you think you could take this piece of paper to your accountant and your bookkeeper, the Rosetta Stone, and you could say, you know what, I'd like to have some numbers like this? How cool would it be if I could show you some software that would do all the calculations for you? I've created that software. It's something that I created because I think what keeps most people from doing financial analysis is they hate the numbers. The math just frickin' wears them out. I understand that. So I created some software that is part of this course that I teach called, 4-day MBA, How Do I Grow My Business and Make More Money? Part of that course is you get the software. That's part of what happens. And here's how cool the software is. Let's suppose your accountant has been giving you a balance sheet, which you never look at. They've been giving you an income statement. Let's suppose you got a couple quarters or a couple months or even a couple years of this. You don't even have to do this, but if you decide to do it, it'll take you a total of 10 minutes. You put in the numbers from a couple of balance sheets and the numbers from a couple of income statements, and like magic, it produces all of the cash and cash flows. Not operating, all of them. Not only that, it'll produce after the fact, a Rosetta Stone. So you don't have to say, well, God, boy, this sure would be cool if I just knew, if I could just go back to last year or the year before and see a Rosetta Stone. Go ask your accountant to prepare a Rosetta Stone for 3 years ago. It ain't going to happen. It could happen for $100,000. All you do is plug in, I'm serious, you plug in a couple balance sheets, a couple income statements, you just type, the form is already there. You just type how long does it take to type in 25 numbers? What does that take? Like 10 minutes? You push a button and it does every single calculation. It prepares cash, operating cash, investing cash, financing cash, Rosetta Stone, every single KPI known to mankind is all done instantaneously. Not only that, when the trend is going the wrong way, the box turns brown. Do you think there might be a reason for that? Yeah, man, that means this thing is starting to stink a little bit, right? So it's literally, it produces graphs. It is so simple to use. The problem that people have is really two things. They don't understand the language. That's a problem. You guys got the bulk of that right now. And they don't want to do the math. I have people all the time say, Keith, would you give us the software? Will you sell us the software? No, I'm not going to do that. You know why? It'd be like giving a 2-year-old a loaded gun. I mean, the question is not if somebody's going to get hurt. The only question is when, right? And this software is exceptionally powerful. So part of what has to happen is you got to kind of have the skills and tools in order. Who's taking this financial literacy? Who's seen that from me? So look around you. Look around you, and you can ask those people, at the break or something, how did you like it? Was it good? Did you learn anything? I mean, ask them whether or not they were a CPA coming in. I guess a lot of CPAs that come see me. And the reason is because they get some skills and tools around how to communicate this very, very complex thing called accounting and financial statement analysis. How do you get it so it's understandable? Where are my accountants in here? Good. Did you guys get some distinctions on how to talk to people? I mean, so that they can get it? So it doesn't have to be complex? How cool is the Rosetta Stone? Is it like you're going, oh, oh? Now the rest of you guys are going, okay, that's pretty good. My accountants in the room are going, are you kidding me? How did he do that? And that's this much. I got skills and tools around this because this is one of the most important things you can know. I'm gonna finish where I started this segment, and that is most people's businesses fail. And the reality is, the reason they fail is because nobody can read the scorecard. They don't know how to grow it. They don't have business skills and tools. They are unbelievably good at painting the house, at writing computer code. But at the end of the day, if you expect to be able to play the game, you got to speak the language. You got to be able to read the scoreboard, because if you can't read the scoreboard, you don't know the score. And if you don't know the score, you can't tell the winners from the losers. Enron, case in point. Nobody could tell the winners from the losers. Why? Because they're stupid? No. Not because they're stupid, but because they're arrogant. Because they didn't bother to learn the skills. At this point in time, you know more about financial statements than the smartest people on the planet on Wall Street, which is spectacular after an hour and a half. Imagine what I could do with you if I had 4 days. You guys are awesome. Thank you for allowing me to be here. I look forward to the next session. Did you learn something? A lot or a little? Thank you. Thank you.